Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Gary Lipsky. Now, Gary is the president of Break of Day Capital, an investment firm that specializes in multifamily real estate in Arizona. Now, Gary brings a 20 plus year track record into the real estate space and has completed more than 300 million of transaction over his career. Now, Gary's also the host of the Real Estate Investor podcast, where he interviews industry experts to provide a broad range of education to various investors. I was just on the show a few weeks back as well. In addition to that, Gary's also the best-selling author of Best in Class. He's the founder of the Asset Management Summit and a guest speaker featured at many prominent conferences. And so, guys, without further ado, I'd like to welcome Gary Lipsky to the show. My friend, how are you today?
Good. Thanks for having me, Kevin.
Yeah, excited to have you here. I know I was on your show a few weeks back, or maybe a few months now. I lose track of time. They all kind of days blend together, right? But I know excited to have you. Flip the tables here today and have you on our show. So why don't we let's just back it up a little bit. Let's give you the opportunity, Gary, for those that aren't familiar with you, that don't know you, don't know your story. Maybe back it up and just tell us a little more about yourself personally and how you found your way into real estate.
I've been an entrepreneur pretty much my whole life, and I looked at real estate as a way to kind of grow my net worth, to build generational wealth. And I even looked at it as my first house I bought for my family. I was having a kid at the time, and found a neighborhood that I could buy into in Los Angeles. I had no money down. And I converted the garage into an office space so that I was able to get $720 of rent money from that to help pay my mortgage. Um, and we opened up the kitchen and we just did some value add for the house. And little did I know that I was planting the seed for a career in real estate. And ultimately I got some single family rentals, and I didn't really get into it full time until 2016, end of 2016, when I sold the business and had time to really study and had some money to invest, and found my way to multifamily, and went from there.
Okay, good deal. So when did you formally create Break a Day Capital? When was that founded?
Yeah, at the very end of 2016.
Okay. Got it. Good
Yeah.
timing. Good timing. So let's just let's take a little bit more of a wider macro landscape. Maybe let's just dive into multifamily and obviously there's been some bumpy years the last couple of years with the rise in interest rates, and seems like they're going to be stuck, at least at a higher point for some time to come. No one surely has a crystal ball that works at this point, but I think we're all making the safe assumption that they'll probably be there for quite a bit of time. So maybe what does in your world? I know that you guys specialize in Arizona. What does the current macro landscape look like in the multifamily sector right now? And I guess maybe not full macro, but let's speak specifically to Arizona, since that's where you guys spend the majority of your time and investment dollars.
Yeah, I would say, in the last 2 years, rent growth has been flat to negative, more concessions, more delinquency. We've had to work much harder um, to succeed than we ever had before, where it was like, we do a reno, fix a unit and get, $150, $250 pop on that unit.
Hmm.
Now we're um, very careful on the units that we upgrade, because we may not get that bump. So we might test out a few and see if it works and then do more, but not all properties are doing it. Obviously, you have turnover costs with staff and for units. And what we're also seeing is just occupancy dip, even though they don't deliver a lot of units in Tucson. Phoenix, they build like crazy. I mean, you've got maybe 40,000 units in permits right now, but that really drops off a cliff at the end of, I think, 2027. You might have, I think, 1,700 being delivered, but they're building in every single corner of Phoenix. So that's why I've gone heavy in Tucson, which is a much smaller market. You're looking at a million plus MSA, where Phoenix is a 5 million plus MSA. But the future looks really good. I do think we'll get a couple cuts, small cuts this year. Obviously, bonus appreciation is coming back. And um, Trump obviously wants Powell out, and we'll get someone that's going to be a lot more aggressive when it comes to lowering interest rates. And I do think a year, 18 months from now, we'll start seeing some more euphoric investing in real estate again.
Have you seen any reset as far as pricing expectations on from sellers? I mean, are you able to make the higher rates today? Are you able to make deals pencil at this point? Or what's that look like in your business?
Yeah, I think it's a really a great time to invest because you're seeing pricing 25 to 30% off what you would have paid for in 2022.
Hmm.
So big discounts. Obviously, the cap rates have increased. And so if you're able to buy now, even if your rate, and the rate is still pretty reasonable. So now we closed the deal in December and January, in March using Lifeco debt, and it was in the low sixes, so pretty reasonable. Very little prepayment penalty, and but we still had 5 to 7 year debt, so we can refinance if we want, and if the rates come down, we can exit if rates really drop, and we want to take advantage of that time. So
Yeah.
I feel like it's a really good time to buy. Plus, this is you're buying at 25-30% off, like if they were to have to build it new too. So tremendous
Yep.
opportunity. I think raising capital is really tough though.
Yeah, yeah, right. When there's deals out there, it's hard to get the capital, right? And yeah, obviously a couple years back, capital was free flowing and a little more challenging to find the opportunities, right? Because there was a lot of capital chasing them. What have you seen as far as like the institutional investors? I mean, you mentioned Tucson. I know, we're not talking about the Phoenix MSA. Tucson's a much smaller submarket. Is there institutional competition in Tucson that you guys have to deal with?
So it's a good when institutional buyers are competing, that's a warning sign for me to like, okay, we're near the top of the market because they're fishing in those waters where typically they're going to be at a much higher level, but that would have been my warning sign in 2022 when I'm visiting properties and I keep seeing institutional buyers competing against me. That's the warning sign, like, hey, we're near the top, and they're looking for yield wherever they can get it. So yeah, not nearly as many. It's not nearly as sexy as a market as a Phoenix or a Dallas or a Houston per se, but there are some on the I would say 50 million or more, you know.
So yeah, so what you're saying is maybe back in 22 before rates went up, you did see institutional investors start finding their way to Tucson, right? Maybe because they were getting priced out of some of the larger markets like a Phoenix, right? Okay, gotcha. That makes. What are some of the biggest? Well, let me back it up. The property management. Are you vertically integrated or do you outsource to third party?
Yeah, we outsource to third party. We don't want to have that. My previous business, I had over 700 employees and 700 independent contractors, and it's just an HR nightmare. We want to focus on what we do best. So we own 8 properties in Tucson, and our property management company owns 53. So we're able to leverage their economies of scale, their relationships, their data, but we don't have to build that infrastructure ourselves, which is really nice. And if we don't like Tucson at some point, we can switch to another market and not be beholden because we have a property management company there.
Yeah. What are some of the biggest challenges of not having your property management vertically integrated? I know there's definitely some benefits of not having to build out that team, the infrastructure. There's a lot to it, right? And property management's not a sexy business and it's not a very profitable business. But so yeah, obviously beneficial to have a kind of leverage a big group like that that's already built out the infrastructure and the team. But I'm sure there's probably some challenges with it as well. What are some of the biggest ones that come to mind for you?
Yeah, and whether we owned it or not, we still have those challenges. And so what
Mhm.
we try to do is, let's say they're a 7.5 out of a 10, or maybe, we try to get them to an 8.5 or a 9 and cover those gaps. But I guess speed, they never move as fast as I want them to. If I had my own company, property management company, I don't know if that changes, quite honestly, because I'm always like, let's go, and I'm waiting. And I guess control over data. We just diving into the data, seeing everything as much as we want. But it's a good partnership, and we there's a lot of trust, which doesn't happen overnight because we want them to say, we'll have them to provide their own pro forma for looking at a property. We'll do ours. I won't share it with them. I want to see what they come up with.
Hmm.
So it's good to have those a separate set of eyes. We want them to push back if they don't think we can get those rents or we can get more rents. We want independent thought.
Hmm.
So plus minus, but that's really important to us to have that partnership where we can really rely on them.
Yeah. Have you seen any, unique strategies that they've come up with here over the past year or two since, rents have kind of been flat, having to give out concessions, higher default rates. I mean, have there been any unique strategies that they put forth that have that you've seen success with?
Um, it's a lot of tinkering, and what works in one submarket might not work in another submarket in the same
Mhm.
city. It's some advertising, some geofencing that and it could work, yeah, for a few months and then stop working. It's constant tinkering. But I would say we're probably pushing more innovative things than they are and saying, hey, what about this? What about that? What about this? Let's try this. Um, and I think that's typical of property management companies that may be a little bit more outdated in how they do things and the technology they use, and we're constantly pushing for more of that. So I guess
Hmm.
that would be one of the weaknesses. They're not implementing things as fast as new ideas as fast as we'd want them to, but we're very hands on, and so we're able to kind of push them and bring them along on that weakness that they may have.
Yeah, yeah, no, absolutely. Have you guys begun leveraging any type of AI within the the business itself, whether it be work with the property management company or on the executive side of things?
Yeah, I would say less on the property management side. One thing we do is called box brownie. So we'll take pictures,
Mm.
not necessarily AI, but like pictures of a unit, and then they could fill it in with furniture and whatnot, and it looks fantastic. So we don't have to stage a unit per se on a smaller building. It looks staged and it's relatively cheap. On the investor side of things, we're using an AI bot to connect with investors. And so, it might be a few percentage points that we're connecting with them, but we've definitely converted investors, and we have some people that have moved that were like, let's say, on a cold list to maybe a warm list.
Hmm.
So that's been effective for us. We've loaded up also all of our newsletters to investors. And so um, if a call comes into our IR person, they can look at the data and the information. They can just pull it up and see, oh, well, this property is performing X or Y. Um, that's something we've been doing. We've loaded OMs into AI to get like a briefing if we want to
Hmm.
send it to some investors and get like feedback or like a partner. We want to be doing more on the property research side of things when we look at a property, um, pulling data from different sources as far as um, demographics,
Hmm.
income. We have those tools that we can use, but we wanted to like pull it from all the different resources and make it nice and neat. We haven't gotten there yet,
Yeah.
but that's something that we are working on.
Okay. Good deal. Good deal. Yeah, and I think there's a lot of opportunity there in our space to to leverage technology to really create efficiencies in the day-to-day operation and like all those little admin type tasks, right? And it's a beautiful thing. We've started leveraging it quite a bit in our business, doing those same things, even just created a GPT to essentially go out and for us for us getting rental comps in the mobile home park space, it's not as readily accessible as it is in the multifamily space. Multifamily, you've got CoStar and other groups similar to that that aggregate all that data on an ongoing regular basis, and that doesn't exist in our sector. And so it helps us when we're going to different markets. You know, we own in many markets across the country. Some of the markets we're not privy to, you know, where the rents are at in the competing neighboring parks. And so anyway, just I think there's a lot of you know, historically that was all manual internally. We had someone pick up the phone and literally start dialing to find
Yep.
out, you know, what the rent comps are in the marketplace, and it's time consuming and just, you know, easier to have technology do that than a physical body. Um, what you know, I guess looking back over the last a couple of years, you know, let's say, you know, I guess back to 2016 even, when you founded Break a Day Capital, what's one deal that taught you the most, good or bad? What comes to mind?
I would say the first deal because you just don't know until you're in the thick of it. And it taught us the attention to detail because we go through our financials really with a microscope, and I think a lot of owners, that aren't on top of it don't do. And we found a charge, I think it was for like 15,000. It was supposed to be for some other property, and it was just a mistake on the accounting person's um but if we never went through our financials with a fine tooth comb, we never would have caught it, and we would have been down 15,000. So, and just managing through the process, and even a deal that you could struggle on could reap big rewards. And that ended up, that deal ended up being really good for us. But learning that this was a small property, 42 units, and knowing that it's much more efficient to go bigger for us.
Hmm.
Your expense ratio goes way down. You get better staff. And it's the same amount of work, a 42 unit for us versus 142 units. So from there we went bigger. We were able to pool our resources. So it was just a great learning opportunity to get our hands dirty on every facet of the business.
Okay. Yeah, no, good deal. You mentioned earlier in the show that one of the challenges, it's not necessarily finding deals today, it's finding the capital, right? Any pivotal changes you guys have made inside the business to help you find success of raising capital at this point where it's again much more difficult?
We do a lot of different things, and I would say not one thing is like that's the winner. So, social media strategy. I've written two books. We hosted a summit um, that we brought really good speakers, curated them together, speaking on other podcasts at some investor real estate meetups. It's definitely not. A lot of them are not worth the time, to go.
Yeah.
Um, but just trying different things and seeing what works. And I think you've got to really put yourself out there, and people will come on board. Referrals, quite honestly, is the number one way. And
Hmm.
so we all want to like speed things up and get more and more investors, but having successful deals and those investors telling friends and coming back
Yeah.
is the number one way to like increase the amount of invested with you.
Yeah, I mean, we always like to say we like to go much deeper than wide. I mean, while we'll cast the net, we like to, you know, really focus on those that have been, you know, have a track record with us, that have invested not just in one deal, but multiple deals over the last couple of years, and you know, get within their network, get with, you know, you've got a testimonial, you know, we treated them well, we provide, you know, steady distributions, we've done what we say we're going to do, and so getting them as a resource and providing a recommendation, it's much easier to source a new investor lead, if it's through someone that you know already knows, likes, and trusts you, rather than going out to the general population. So definitely a lot better to go deep than wide. What is the, I guess, curious to know what the general sentiment is. Obviously, we talk about it's more difficult to raise capital now, but what are you hearing? I mean, what's the chatter from limited partners that are maybe they're currently invested in deals, maybe they're, you know, they're folks that you're having conversations with that haven't yet invested but are kind of on the fence. What would you say is the biggest source of trepidation for an LP maybe not investing at this current time?
So the investors that are in multifamily, they're hurting on other deals. They're not getting cash flow
Mhm.
distributions. They probably had some capital calls. Maybe they've lost their money. They're hurting, and so they're very very cautious. Um, on the other side, the investors that are more stock market focused, tech focused, they haven't been burned as much as your typical multifamily who people were just throwing money at all different deals like, hey, I like that place, I'm just going to double down, that person's doing lots of deals, that person's in social media, I'm going to invest with them, and they've been burned. So it's kind of like, there's two types of investors, and the one that hasn't been burned in multifamily are they're the ones that are investing bigger checks, and not that concerned about the past.
Yeah. If you were giving some advice to an LP that's out there looking at deals, I mean, what are some of the big red flags they should be looking out for if they're considering investing in an opportunity? I mean, obviously one big red flag is like if the current sponsors get a deal that went sideways, right? And that doesn't necessarily mean it was not a great sponsor or great great leadership team. It just things happen, right? And so, but outside of that, which is already a red flag and it's a pretty noticeable red flag, what are some of the other big ones that they should be looking out for? I mean, I guess how do they go about vetting and finding the right sponsor?
Yeah, and that's the key thing, that the sponsor is everything. It's the jockey.
Yeah.
It's someone that has been through market cycles, that isn't going to be overly aggressive, that isn't overpromising. Check their track record. Have they? Is this a new asset class for them, or have they been doing this for a while? Is this a new market for them, or do they have some tie to the market that if they're going into something new, like what's the story behind it? Have they been focusing on that market for years and building data points and not transacted, or do they have someone else that they're partnering with for them to go in a new market? Those are the really really key things. And if a deal sounds too good to be true, it probably is. And I know myself as an investor, I chased IRR on a deal because it looked great. And hey, if they didn't hit the 25% they said they would, and they get to 20%, I'd be feeling pretty good. But those are the deals that you lose all your money on, because they don't just miss a little, they miss a lot,
Yeah.
you know? Um, and I've had investors chase bonus appreciation as well. And I'm like, chase a good deal and everything will work out. And when you're chasing bonus appreciation, when you're chasing IRR, you more often than not, you're going to get burned, and maybe you get lucky, but go with the operator who's nice and steady, who's not pitching grand slams. You're going to do much, much better.
Yeah. Excited to hear the news that the bonus depreciation is coming back right now. It's a permanent piece of the tax code. We'll see, if that sticks around forever like that, or if it gets changed at some point. But I guess I'm curious to know kind of or get your opinion on. Do you think, being that that's back now, obviously we're in the latter half of the calendar year. It seems that typically in the fourth quarter is when a lot of folks really start trying to figure out their tax strategy for the year. Hopefully, they're thinking about it much earlier in the year, but ultimately, there always seems to be a flurry of transactions that happen in Q4, trying to get them closed out for the calendar year and take advantage of some of those tax breaks. Now the tax breaks are huge. Do you anticipate that there will be more competition coming back into the multifamily space as a direct result of the bonus depreciation coming back at 100%?
Yeah, I think that will, there'll be more deal flow, more buyer action, more investor action as well. It'll work its way up. Um, it's not gonna happen immediately, but as the year goes on, I see more deals happening. I see cap rates compressing. Um, and just overall in sentiment pick up, because people are going to be maybe cashing out of Bitcoin, maybe cashing out of the stock market, which are near all-time highs or all-time highs right now. So um, and more and more money flowing back to multifamily. There's so much dry powder sitting on the sideline. So
Yeah.
um, so I think it's going to flow into all areas of real estate.
What are you most excited about over the next 12 to 24 months? What keeps you up at night in a good way?
I'm a deal junkie. I love I love seeing a property and seeing what we can do to it and turn it into a cash flowing machine. So I'm excited about more deal flow coming in
Mhm.
that'll improve the value of the properties that I own currently and increase the value of the properties I will be buying over the next 12 months.
Yeah, yeah, no, absolutely. Um, Gary, for those that want to learn more about Break and Take Capital, get in touch with you. Where's the best place to track you down?
Yeah, head to our website, bragofthecapital.com. You can get links to our website, social media. You can get on our newsletter. So check us out.
How about your book? Is that on the website as well?
Yeah, yeah. Invest Smart and Best in Class. You can buy both on Amazon or on our website as well.
Okay. And do you currently have any offerings that you'd like to speak to that are open and accepting capital?
Yeah, yeah. We have a little bit space on a deal that we bought a couple months ago. Icon on Headley. It's in Tucson, 136 unit, 1999 build, mostly 2 and 3 bedrooms. So a little bit of space left on that, and then we're in a best and final on a deal right now. So we'll see. Offers are due mid next week, so we know where
Okay.
our number is, and if someone comes in higher, when so be it.
How does best and final look today compared to what it looked like 3 years ago?
Yeah, it's a
It's a
lot
much
different
different experience,
because
right?
because our number is our number. It's not like there's no more juice to squeeze. But I guess they're hoping on interest rates maybe dropping by then, and because we're not at the number that the seller wants, obviously we're well below it, and that's been the case on a number of deals over the last year or so, where they're hoping to get to their number and they just don't, and most of the time they sell, but there are times when they're like, I'm not going to sell at that number.
Yeah.
So it's a little bit of a dance. Brokers pushing to squeeze out every last bit that they can, and you just got to stay true to your underwriting.
Yeah. Have the days of hard money day one, are they long gone?
There's still some deals. We lost out on a deal. It was small, or I would say a low cost product because it was like 1970. And I needed a ton of work, but boy, it was tremendous upside on it. That someone beat us because they put 250,000 hard day one, but on a much bigger deal that we're going after now, we're not seeing that we have to put very much hard money down. Very minimal. Maybe it's 25, 50. So for the most part,
That
most
still is a
deals are.
factor though. Okay, so that's still
Yeah,
happening. You guys,
yeah.
so you have to commit some hard money day one to really make it to be competitive. It still seems like in the landscape.
Yeah, and we're selling a deal too, and we're making the buyers like, for us to waste our time with someone, we're like, just put even 20,000 down, just so like it pays for our time. Even
Yeah,
if you like back out, just we want them to have a little skin in the game. So I understand it from a buyer standpoint too. Just put a little bit
yeah.
down so that we're not wasting our time.
No, all good, all good. And guys, I'll put all the links in the show notes as well that Gary had mentioned. Gary, I appreciate you coming to the show, man. It's been a pleasure getting to know you, chatting with you, and lots of insights shared. And yeah, wishing you all the best, my friend, and hoping that you get that positive phone call that you were selected for that deal that you guys are best and final on.
Well, I appreciate it. Thanks for having me on, and great talking with you.
All right, guys, that's all we have for this week's show. So until we meet again next week, this is your host Kevin Bupp, wishing you huge success. Take care now.